The 1031 exchange. If you're in real estate investing or thinking about getting into it, you've absolutely heard this term before. It's one of the most powerful tax deferral tools you have at your disposal in any form of work. But there's a couple key things you have to make sure you're doing right, or you are going to torpedo the whole thing. But first, we need to look at some X's and O's. We want to understand how the 1031 works so that we can build upon that and really see the strategy behind it. Let's take a look at the X's and O's. Hey, thanks for keeping up. Take a deep breath. We're looking at the 1031 exchange here. We're going to get our blue pen because that's the important one for learning. We're taking a look here. How does this thing actually work? What are we dealing with? And why would we go about it? How do we find ourselves in a spot where we need to be thinking about doing it? The answer to that is real estate investing, of course, because it's going to come about when you own real estate investment properties. In this case, we're looking at residential real estate. You own homes. You're a landlord for people who go out and rent your house, right? In this case, the property you own, $400,000. It brings in $2K a month. Let's say it covers your mortgage. You're in a good spot. When you go to sell this property, you're going to have some considerations to put it in the microscope here. The sales price minus the cost basis is going to be your taxable or your potential taxable gain, meaning what would be subject to capital gains taxes. But there's a kicker within that, right? You have your depreciation recapture here. I've erased it a little bit, but the depreciation recapture is the real kicker, right? If you've taken 10 years of depreciation for $80,000, that $80,000 is going to come back and be taxed at ordinary income tax rates. So think the marginal tax brackets you might be familiar with. You're not going to get the capital gain tax treatment on that. That's a little more favorable. So those are our key taxable components that are going to arise if we choose to sell this property. And that's where the 1031 exchange comes in, right? We're going to take this property and instead of selling it, we're going to sell it and then invest all the proceeds into a new property. So we're not going to keep that money and we're not going to go and spend it on other things. We take all those proceeds, we invest it in our new property. And the reason we did this in the first place is likely because this new property offers a greater potential, more income. It's just better overall. It fits in with the plans you have in the future. But the point being, what's going to happen now if you 1031 exchange this is this whole thing right here, your sales, but your taxable elements, if you will. We're going to slide it down here and we're going to go into the deferral box. Meaning, what's a tax deferral? Essentially, that's pushing off taxes to a future year of some kind. Easiest description. You're pushing off taxes to a future year. In the case of the 1031, what you have at the end of this whole journey is the ability for your heirs to inherit these properties completely tax-free. So you can essentially turn what's a tax deferral, something where you would eventually pay these taxes down the line if you sold this property. If you don't sell it and you let someone inherit it, this whole deferral thing becomes essentially a tax elimination tool. A great thing. But for now, it sits in our deferral box. We've got our new property. We chose this property because look, $650,000. We have the capital now to spend on a bigger property that's going to offer us more income, 2 doors instead of 1. There's a whole bunch of reasons that you could end up in this situation. But once you're here, it's a journey you're probably going to be in for life because you need to continue doing this forever and ever with this property until it gets to the point of being inherited. So, key elements, you can really defer a lot of taxes here doing this strategy, but it is a long-term strategy, very long-term, in that you probably may not very well be alive to see the seeds reaped of this strategy in the end. It's going to go to your heirs. So there's no doubt on the surface that the 1031 exchange is a phenomenal tool. Everyone who's in this situation, if you're in a spot where you want to be passing these properties on to your heirs as a part of your estate planning, you should be 1031 exchanging properties. Being in investment real estate is going to be an enormous tax saving tool for you. And what I want to explore a little further is how exactly that works, the tax savings aspect. It's very easy for me to sit here as a tax professional and say you're going to save a boatload on taxes, but I think it's important, especially with this particular tool, that if you're going to be participating in this, you see visually how that's actually going to work so you can develop a comfort that ultimately is going to pay off in the way we're saying it's going to pay off. So let's check it out then. How does the math ultimately play out in a 1031 exchange? Let's say we have a property that sells for $400,000 after 5 years of ownership. 5 years being particularly important to the depreciation aspect for our tax example. So with this, we have a sales price of $400,000. We have a cost basis of $280,000, meaning our total gain is going to be $120,000. In this case, we have depreciation of $51,000. You can see the math, how that plays out there. And what's going to happen ultimately is if we sell this property, we are going to see $69,000, that's 120 minus 51, taxed at, in this case, the capital gains rate of 15%. That's going to be an estimated tax rate in this example, so we can generate a tax amount. And then that $51,000 is going to get taxed at our ordinary income tax rates of 24%. In this case, that's a marginal tax bracket rate once you reach a certain income limit. Point being that depreciation is getting hit with more disadvantageous tax rates. You're getting hit harder if that depreciation is coming back and being recaptured. In this case, our total estimated tax is around $23,000. Of course, let's say that's no bueno for our plan. Of course, we don't want to sell our property and get $23,000 in tax on it. We want to keep this thing for a while. In fact, we plan on letting our kids inherit it. Well, of course, we're in a great spot to do a 1031 exchange. So now let's flip that dynamic. We are going to do a 1031 exchange, and we're going to sell that same property for $400,000. The same properties get sold. We see the math play out here. This is the same as the last slide. So, well, what happens now? Property 2 comes into play. We have a property that we're going to buy for $500,000. You see that cost basis there. That's what's going to become our cost basis if we are to buy this new property. We see this gain now. We can see it circled. The cash impact is going to get rolled directly into property 2, meaning all that gain you actually get, all the money you're getting is going to be invested into that second property and go into helping you finance it. Now we can see in the red there, we have that depreciation per year amount of $18,000. That's based on our new total value. There's a couple different ways to do it in a 1031 exchange, but point being, you're going to have a new higher depreciation amount based on your higher value property. And now you can see how things start rolling. If you're projecting more cash flow here, if you got that higher depreciation amount, the finances are working harder for you, and you're still getting the impact that we're going to see here in a little bit. Now, obviously, we're rolling the cash into the second property to execute this 1031 exchange properly, but what about that tax impact we saw previously that led to the $23,000? That gets put in that deferral box we have. Property 1, that $23,000 in taxes. More importantly, really, the income is going to get deferred, and we're going to see that tax later if you were to sell a property. But for now, and in how we want to execute this, we're going to put that in the deferral box, and hopefully we're going to turn it into a completely eliminated tax impact. And you remember how we talked earlier about how this is a lifetime play you're getting into? Well, you're in it now, buddy. If you sell any property in the future that you're 1031ing, you're going to trigger taxes on applicable deferred gains and depreciation. That's what we're talking about here. This is the whole point of the 1031. That's why this strategy is best when you're holding for inheritance. This is where the tax elimination aspect can come in. And this is where this becomes really valuable. So let's use that same exact example. Property 2's market value is now $600,000. If we were to sell this property, it would trigger a $100,000 gain and taxes on the deferrals and depreciation that would be applicable from the previous sale. That's where the big danger comes in. If you don't know what you're doing, you can end up triggering a whole boatload of things you didn't intend with these taxes. But if you execute this right and you let the property get inherited by your heirs, you get a step up in basis, aka the cost basis resets to market value. That $500,000 cost basis you had originally is going to reset to $600,000 when your heirs get a hold of the property. They do not have to worry about that $100,000 gain, and ultimately that is eliminating taxes. That tax aspect, that potential taxable aspect is gone forever. They get that step up in basis. They're only going to pay taxes on anything they sell over that new cost basis. Now, it's certainly a lot of information being thrown at you there. It's not a simple concept when you look at the details all the way through. But the key thing to really hone in on is that step up there at the end. That is the essence of the 1031. Once you get into it, you can't get out of it without paying taxes, so you need to have that long-term plan. You need to know that's what you want to do with it. That's why you would get into a 1031 situation. Then you can get to the end of that life. You let your heirs inherit it when you pass on. They get that whole step up in basis, whether it's $100,000 like we looked at, or $1 million, or $10 million, whatever it is. They get that tax step up in basis, and they'll never get taxed on that again. My name is Matt Speckman. Thanks for joining us today. Important stuff if you're in investment in real estate. Make sure you can take advantage of these components if you're in the right spot. Do some estate planning. Make sure this stuff makes sense for you. Like and subscribe if you like this type of stuff. Come back again. Lesson videos, tax, finance. Drop me a line. Let me know what you'd like to see. We'll see you next time.